Good morning, good afternoon, wherever it is you're joining us from. Welcome to today's webinar, Should I Stay or Should I Go? Financing or Sale Options for Cannabis Operators. Today, we have a very timely discussion featuring cannabis industry experts from Armanino and Viridian Capital Advisors. We anticipate there will be questions, so please do use the Q&A box in your Zoom dashboard to submit those questions. We'll get to them as time permits during the presentation, at the very end, or if we do run out, we'll follow up with you via email to get your questions answered as best as possible. I will introduce Mike Garral, who will be our moderator today. Mike is a cannabis industry leader and tax partner at Armanino, and he will take it from here. Mike, take it away.
Thank you, Valeria. Welcome, everyone. We've got a great panel today. Let me start with Frank Colombo, the Director of Data Analytics with Viridian Capital Advisors. Frank, tell us a little bit about yourself.
Sure. Thank you. I'm a banker at Viridian, and I handle all of our valuation and modeling part of our practice. I also run our data business, which is our data tracker, our deal tracker, and our chart of the week. Earlier in my career, my background is really credit. So I was previously the head of high yield research at UBS and distress research at Seaport Global and Bankers Trust Credit before that. So that's a little about me.
All right, next we have Scott Greiper, President of Viridian Capital Advisors. Scott, tell us about yourself.
Mike, that's a dangerous question on an hour webinar to ask me to talk about myself. I'll try to keep it short. Founded Viridian Capital in June of 14. We were the first financial services advisory practice that was FINRA licensed. So we were the kind of the first broker dealer in the US cannabis space. So we're in our 9th year. We've done a lot of good transactions representing clients across the country, capital raises, equity and debt, primarily M&A on the sell side, representing.
Oh no.
Scott
We're
froze.
losing Scott. Let's go on to Michael Hogan, consulting partner with Armanino.
Thanks, Mike. So my name is Michael Hogan. I'm a partner with Armanino. I've been working for 35 plus years with companies that are facing nexus points in their business, advising them through different options and approaches to how they go through, and have in the past 5 years been working with our strong cannabis practice as in helping some of our clients look at some of those options.
All right. Scott, did you want to jump back on and finish what you were talking about? I don't know if we have Scott back.
There he's back.
Yeah,
Oh,
guys,
there he is.
can you hear me?
Yes. Yes.
Sorry about that, guys. I'm actually in an airport in a quiet room here, so I just switched Wi-Fi. Apologies. I just want to finish up on the Viridian Cannabis Deal Tracker, which we launched in January of 2015. We've tracked $70 billion of deals in this industry. Every equity investor and what they invested in, every lender and who they lent money to, every acquirer and who they acquired, by state, by license stack, by type of business. So the underlying data that you're going to see that we're partnering with Armanino on today is data and analytics from the deal tracker. And let me finish off by saying we've been developing a close relationship with Armanino over the last year. They're one of the leading companies of its kind in the space. And I always thought that it was valuable in an industry as, I'll say, unusual as our industry, that market leaders come together to properly advise companies. So appreciate the opportunity to partner with Armanino today.
Thank you, Scott. Chad is the Transition Advisory Services partner at Armanino. Chad, tell us a little bit about your background.
Yeah, hello everyone. I'm Chad Zredek. I'm a partner with Armanino's Transaction Advisory Services, specializing in M&A consulting. I've spent the better part of 25 years doing strict M&A consulting, many of them in the cannabis sector, and we help companies prepare to go to market, as well as advise on companies buying it and firms investing in the cannabis space, and collaborate with firms like Viridian.
Thank you, Chad. So what are we going to talk about today? We're going to discuss the state of M&A and the capital markets in cannabis. As you well know, last year was a tough year for the industry, and I think this year, could be a good year for M&A, and the key is going to be timing and making sure that you are well prepared to make, one of these, several options that we're going to present to you today. And really help you decide what to do next in this environment. So we're going to talk about, raising capital, both equity and debt, and maybe this combination of both might suit your needs. We're going to talk about divesting non-core assets. And then we're going to talk about sale leasebacks, which is really helpful if you own the real estate that your company uses. And then talk about opportunities to sell the company, and finally, whether or not to go public, which is still an opportunity for you in the Canadian market. So with that, let's move on to the state of M&A and capital, and Scott, take it from there.
Thank you, Mike. If we could flip forward one slide, we can get into the data. So here we're giving you guys a look back from 2019 to last year. This is all the data from the Viridian Cannabis Deal Tracker on number of M&A transactions and the dollar value of those transactions, the number of equity raises and the dollar value of those equity raises, and similarly, the number of debt financings and the dollar value. What is very clear here is that 2019 started off as a very strong year. We came off of the midterm elections in 2018. We added a number of new states, including East Coast states, and 19 was looking at it like a very good year. As a matter of fact, it represented the high watermark at that point of time of deal-making activity in the industry. Well, that all started to end in the second quarter of 19, when the public Canadian LPs and then the public US MSOs released Q1 earnings. So this is going to be during the second quarter. And the earnings and the results were poor. And they were below analyst estimates. That told you two things. The analysts were overestimating the performance of the public companies. And those estimates have come down drastically over the last year. And secondarily, cannabis companies were not performing according to their expectations. We started to see capital come out of the market. And as capital came out of the market, the acquirers, who have primarily been the public companies, became weakened. They had lower stock prices. They had less cash on the balance sheet. It weakens their position as a buyer. So to the end of 19 into Q1 of 20, there were virtually no deals happening at that time, particularly in M&A. And who would have known it? I'll say nobody, maybe Nostradamus, that COVID would have been the event that drove a recovery in the cannabis capital markets. And it did, because let's say COVID happened in March of 20, by the second quarter of 20, cannabis companies were reporting record results, record top line. There was a rush of buying activity on the part of consumers. They were buying toilet paper, they were buying Clorox, and they were buying, vapes and flour and edibles. Maybe because they had more money in their pocket from the PPP loans, maybe because they needed some way to chill out from this terrible epidemic. But COVID in many ways really helped the industry recover. And then you go into 2021, and that was in fact the high watermark for deal activity, number of transactions, and dollar value of those transactions. Why? Democrats won the White House, the Senate, and the Congress, and there was a mad rush of capital, including some institutional capital, that was expecting some regulatory change, whether it was a rescheduling, maybe a descheduling, we don't see that happening, or a Safe Banking Act, which would allow the FDIC-insured banks to truly come into the industry. That's what drove the numbers you're seeing in 2021, record levels. And then we get to last year. And what happened last year? There was no regulatory process. Safe Banking Act passed the House for the 6th year in a row, never got to a vote in the Senate. There was no rescheduling, and it took the air out of the market in terms of companies, investors, buy-side players that were betting on regulatory reform to take this onus off of the industry. It's a weird dichotomy because the industry did over $30 billion in legal sales last year. When we started Viridian in 2014, it was about $2.5 billion in legal sales. So the industry from a legal sales, legally grown cannabis, state licensed operators it's sold in a state licensed dispensary has increased 15x since we opened our doors. And yet all of the restraints on raising capital really hurt the industry last year, including finally seeing commoditization of flower pricing, particularly in the wholesale side, and inflation cutting into the consumer wallet. So 2022, you saw the number of M&A deals down 29%. The number of equity deals got crushed. Equity is really prohibitively expensive today for public companies and private. Equity raises down 58%, debt only down 7%. So thank God for the emergence of the lender in this sector, which has really happened over the last 3 years. And Frank will take you through a slide showing that the preponderance of capital financing in this industry is debt. One other thing, and then I'm going to ask Frank to jump in. So equity's down 58%, particularly for the public companies who have been the primary acquirers in the space. I think since we started the deal tracker, the public MSO in particular has been the acquirer in 85% of buy-side transactions. They're public companies, they have a public stock price to use as consideration, and they have a better ability to raise capital. Well, last year they didn't, and yet M&A was only down 29%. M&A has changed in philosophy and strategy. In 2020, 19, 18, 17, it was a land grab. The Canadian LPs, the US MSOs were buying everything that wasn't nailed down. A state licensed operator, a cannabis lab, an extraction facility, a telehealth medicine play. They were just hedging their bets on what would work, and they were buying everything. That is over. The capital markets will only support acquisition activity that is strategic to the core business of the buyer, that is accretive to the core business of the buyer, whether it's buying revenues or earnings or IP or regional presence. It is no longer let's buy everything that's not nailed down. You're not going to get capital to do that. It's got to be strategic and accretive. That's what's changed in M&A. Frank, you want to jump in before we go to the next slide?
Yeah, I would just also point out, looking a little below those numbers and the change between 21 and 22, all that exuberance that Scott talked about in 21 really showed up in terms of jumbo deals. So in M&A, 6 of the 10 largest deals that have ever been seen in cannabis in history happened in 21. Deals over in that 17 billion number, there's 8 billion in there represented by transactions over 500 million in size. And compare that to 22, there were 0 transactions over 500 million in size. So a big part of that drop off were these jumbo deals like Tilray Afria and Weed Maps and True Leaf Harvest Health. Some of the, those mega deals that were, each of those that I just mentioned were over $1 billion, just didn't happen in 22, partly because the stock prices are down. Similarly, on the equity side, what really happened in 22 was a big part of the market, the cultivation and retail sector, was virtually shut out of the market. And it happened on both sides. The companies didn't want to sell stock at low prices, and the investor didn't want to buy them either. So when you look at 21, cultivation and retail sector, just in the US, had $2 billion worth of financing out of that $7 billion. In 22, that $2 billion went down to under $100 million. So 2 billion to 100 million. So that shows you the severity of the pullback in equity raises. And as Scott said, where did it go? It went to debt. So we'll be talking a little bit more about that.
Yeah, why don't we
coming up.
flip the slide? Because I think we're going to go into the debt financings. Okay, this is M&A.
This M&A activity, once again, if you look behind these numbers, you can just see the dramatic change in the size of deals. If you put together those numbers for 21, you'd find that the average deal size is 78 million there. And flash forward to 22, it went from 78 million to 30 million. And actually in the second half, it was 16 million. So deals, the big deals just went away. And that's, I think, the big takeaway from this slide. So on debt, you can see that this is a trend that's been happening for several years, the increased amount of debt. And part of it is just the maturation of the industry. More and more companies turning in positive EBITDAs. Most recently, some are positive cash flow from operations, not many, but a few. So that's part of it. And also part of this is a geographic shift. Going back to 2019, 75% of all the financing was Canadian companies. I mean, I'm sorry, that's about right. And, a small amount, 25% US. By the time you get to 2022, 75% of all of the financing, debt and equity, was US companies. So why does that matter for debt? The US MSOs had stronger financial profiles, more EBITDA, more collateralized assets, so they were able to attract this debt. So the mix shift, the geographic shift is part of it. Another part of it is the cost of debt came down dramatically over this period, and partly because there was a big shift between equity-linked debt, converts, and debt with warrants. In 2019, 80% of all that debt there was equity-linked. By the time you get to 2022, only 5% of it was equity-linked, and that reduced the cost dramatically of this debt. So that's another factor. We try and keep a close eye on the cost of debt, and it's deceiving. You have, rarely is the coupon or the interest rate the biggest part of debt cost. So for instance, Canopy Growth just did a 5% convert last week. And by my estimates, that 5% interest rate was less than a third of the overall cost of that financing. So we actually value the options that are embedded in these structures and really try and get down to looking at what the real cost of debt is. And it came down dramatically over this period. Another factor, just to throw this in, I'll try and wrap this up. You have a rise in cannabis lenders over this period. The sales leaseback providers, the big cannabis lenders. And in a way, it's kind of regulatory arbitrage because institutional investors who might want to lend to cannabis but can't because of the illegality instead invested in these organizations that in turn lent to cannabis. So it's kind of like second order lending, if you will. So now, you see that there's been a reversal recently in some of these trends. The cost of debt now is heading back up. Rates are up 400 basis points on treasuries and risk spreads are up even more. So we're starting to see things go back the other way in 23, where equity linked deals are creeping up. The cost of debt capital is creeping up. Having said that, the equity markets are still prohibitively difficult. There's still all this regulatory uncertainty. Nobody wants to sell stock at the absolute bottom. And it's even worse if you sold stock at the bottom and then deregulation happened and your stock was up 50% and you were the guy that sold at the very bottom. So that's what's happening with this mix of debt and equity. We think it's going to stay well over 50% for the foreseeable future.
Thank you, Frank. So guys, this slide is taken from the Viridian sector tracker. We track every capital markets deal. Again, whether it's equity, debt, or capital raise, debt or equity, buyers, sell side M&A, going public. we track it by one of the 12 industry sectors. We put out our first report in November of 2014, and it was landscaping. What is the business of cannabis? Because it's not flower and bongs. It's these sectors that underlie the business of cannabis in every legal state in the US and every legal country. And if you look at these sectors, there's quite a set of institutionally owned asset classes that make cannabis not so far afield for the institutional investor. You have real estate, that's underlying everything. You want a license, you've got to open up a grow, you've got 9 months, whether it's indoor, outdoor, or greenhouse, you've got to find a piece of real estate that's permitted and zoned by that state or that city for a cannabis grow. You have software and media. Software is one of the largest owned institutional asset classes in the world. Biotech pharma. There's now 4 FDA-approved cannabis-derived drugs. It's not just Epidiolex from GW or Jazz Pharma. You've got ag tech, which is all of the sensors, the lights, the dehumidification systems, nutrients, power, water. So you have really very traditional asset classes that sit within the business of cannabis. We were astounded when we did this back 8, 9 years ago, because we didn't realize that the institutional investor, which has not been in the industry in the main, actually should be, because there are ways to invest in these sectors that are very traditional for them. Let's get into what this slide means. So,
hey, Scott, there was a question there. Somebody was asking, how do you accurately know about private deals in your numbers?
Yep. Look, that's always the challenge for any data service, whether it's Bloomberg, PitchBook, or little old Viridian. But over the years, we've developed over 400 feeds that pile into our database every day, and are with certain algorithms that will break it up into which sector and which state. That includes local trade rags in Washington State, in Oregon, and Colorado, and in Michigan that are reporting on local business activity. XYZ company raised $7 million. It happened to be a state licensed cannabis company. So we get these feeds in, several hundred feeds in every day. We've also been, thank God, we've become so well followed and so well known for this research. We've got 21,000 subscribers to this, that companies call us and say, by the way, I want to make sure that you cover my $3.5 million raise out of Ohio that you might have missed. Because the tracker has been so well consumed and followed globally, it's a little bit of a marketing document for companies wanting to be involved. That's how we follow the private companies.
Hey, Scott, one other question I have is, psychedelics, I've noticed, what a huge change that has on your chart there from last year to this year. And, with all the markets being so tight, why is there so much interest there?
I'll answer the question directly. We financed Israel's largest medical cannabis company in 2017. And we felt really blessed to get that, because we believe that the medical side of cannabis has really the largest market opportunity, probably the largest TAM, because cannabis has been used for millennium to treat sleeping disorders and eating disorders and anxiety and chronic pain, right? The 4 main medical conditions that opiates are prescribed for, which translate into probably $80 billion of purchasing of opiates last year: sleep disorder, anxiety, chronic pain, and eating disorders. Cannabis can replace that. We just need clinical trials. Why has psychedelics grown in terms of capital raised in the sector? Because you've had various psychedelics that have been legal for years. Ketamine, I believe, was FDA approved in 1976. Psilocybin, MDMA are now getting approved at the state level: California, Oregon, California. There are probably more than 30 companies that are doing traditional FDA-approved clinical trials on psychedelics, many of which went public on NASDAQ in the last couple of years and attracted institutional funding. from biotech funds, from pharmaceutical funds, from drug development funds. You don't have that level of institutional activity in cannabis because it's still Schedule 1. So this is an opportunity for the traditional healthcare, biotech, drug development investor to invest in a segment of this space that is getting approval to run clinical trials. That's what's happened here. I think there were more than 30 or 35 IPOs of psychedelic companies on NASDAQ. You don't see cannabis companies trading there unless they're software companies or the real estate companies. So it's just been a sector of the industry, Mike, that has attracted institutional capital because they are running along FDA-approved clinical trials. And so far, from some of the companies that are in phase 3, phase 4, the efficacy of psychedelics to treat, not to mask like a Prozac does, but have a curative property to treat depression and anxiety is stunning. That's the reason this sector has attracted the capital.
Thank you, Scott. We need to move on to some of the other topics here.
Okay, so here, similarly, we track every deal by sector. We track every deal by state. So we want to have actionability to our data. Which sector of the industry is attracting capital or not, is being acquired or not, and similarly, which regions. These states are where the cannabis companies or the CBD companies or the psychedelic companies are headquartered. So we track every deal back to that because we want to be able to advise our clients as to get into California or get out. We put out a chart of the week last April saying we're noticing that there's less and less capital markets activity in California. You probably should wait. And what happened? Wholesale pricing started to get crushed. So we're tracking deals by state so we could provide actionability on rotation of capital in and out of each state. I won't go into the detail, guys, because I think we're running a little long. Obviously, we could talk afterwards, but same thing on M&A. We're tracking M&A transactions, buyer and seller, public and private, by industry sector, because they're all different. And if you look across these industry sectors, most are down this year, except for software media and psychedelics again. So there's trend analysis to be done here, and we have 9 years worth of data of how capital at M&A is flowing by state and by sector. Let's flip forward, please. Here's the M&A. Whoop, just go one back. I'll spend 30 seconds on this. There you go. So here you see that New York and Texas have been rocking and rolling in terms of up activity in this year's period versus last year's. Why? New York is handing out a lot of new social equity licenses. Riv Capital paid, I think, $240 million to acquire Etain. So this M&A activity is due to the fact that there's more operators out there. Many are underfunded, and so larger companies are coming in and acquiring them and giving them the capital to build out infrastructure. In Texas, similarly, there have only been 3 licenses. One of those has been our clients for the last several years. Texas is now handing out up to 15 new licenses. And for companies that are not represented in the second largest state in the country, and if they didn't apply for a license, they're buying the license. So the M&A activity by state for this year's period is happening in 2 states that are experiencing an expansion in licenses, New York and Texas. We could go ahead next. I think, Frank, you're jumping in on this.
Yeah, this is a controversial slide, I would say, because what it shows is the level of M&A activity by half year, going back to 2019, and how much of it, the consideration was stock or cash or other, which would include seller notes and contingent payments, contingent payments, earnouts. And the black line is the percentage of stock that was used in consideration. And it's no secret why that percentage peaked out at about 65%. This is only US cultivation and retail. Peaked out in 2021, just as equity prices started to dive. And so this nosedive you see in the beginning of 22 really is a reaction to the fact that company MSOs didn't want to use their stock as consideration because the values were way down. And we're seeing something kind of interesting in the beginning of 23. The percentage of stock in acquisitions actually started to edge back up a little bit. And my hypothesis is that this is happening for a couple reasons. One of which is that after SAFE Act failed, the power, the relative negotiating power shifted out there from sellers to buyers. And many of the smaller companies who would be M&A targets are having tough time accessing capital. They're more anxious to become part of bigger organizations. And so the relative power, negotiating power of MSOs has gone up. They are able to use stock in transactions more. It's more accepted because the smaller companies want to and feel like they need to be part of a bigger organization. They're looking to be part of a platform to go forward. And they've kind of realized that in many cases, going it on their own just isn't a survivable strategy in 2023. So I think that's why we're starting to see that edge back up. It'll be interesting to watch that through the year. I think that that may be a trend that continues.
Thank you, Frank. So what do you do next? You know, we've gotten a lot of statistical information from Frank and Scott. You know, now we're going to talk about, you know, how you would decide what to do next. And I'm going to turn it over to Chad to talk about some of these topics.
Yeah, and I think what we're going to dive into is the different options you have, but really before we even get into the options, what do you have to have in hand to pursue really any of these options? But it really all starts with sound financials that can be used for the historical assessment of operations, as well as basis for projections, which feeds into overall enterprise valuations, and also just key diagnostics on running your operations, as well as the identification of risk, red flags that you want to, if you are going to market or talking to potential investors, that how to mitigate things prior to going to market, as well as highlight the strengths of the company. But what we found in this sector in particular is really getting back to basics, having good, sound financial statements that people can make judgment calls on. And that is where I have spent the bulk of our time, is in assisting companies frame out the foundation for the modeling and the forecasting, and for the bankers to also provide sound advice.
Chad, talk about timing. You know, a lot of this sounds like it would take a good bit of time to be able to develop.
Yeah, so from a preparation standpoint, from when we get involved, assuming there's not a ton of cleanup, it's generally about a 5 to 6 week period to organize the numbers and provide support that would be usually requested upon ask after going to market. So it's usually about a 5 to 6 week period for pulling together a very sound historical data book, as well as pressure test some of the projection assumptions to align that with near-term historical financial results. That's only a small sliver of probably the entire timeline to, you know, go to market from start to finish that Scott or Frank could expand on.
Scott, you're on mute.
Couldn't agree with you more, Chad, in the criticalness of getting ready to go to market by creating a financial model that ties together income statement, balance sheet, cash flow, and where all the inputs of revenue growth and margins and expenses is relevant to your license stack in your state, in your county. or if you're an ancillary provider, what's relevant to your business. We've probably done more than 6 dozen valuation assignments for clients over the years. And those valuation assignments is not an academic exercise, as you were saying, Chad. It's getting ready to go to market, knowing what you're worth, knowing what the structure of your deal should be based upon the last 30 deals we pull out of the deal tracker, so that you have leverage in negotiating with a buy-side player. And those 6 dozen or so valuation assignments and modeling that we've done has led to over $700 million in deals. So getting yourself ready with a group like Armanino or the group like Viridian, according to these 5 different bullets here, is critical to increasing the likelihood of success, increasing the likelihood of getting a deal done in terms and structure and valuation that you deserve, and increasing the likelihood of getting a deal done in a decent time frame. To us, whether it's a capital raise or it's buying or selling a company, that's a 4 to 6 month time frame. Could happen earlier. We've closed deals in 3 months. We're very targeted in our outreach, but it is a challenging market. So I think a 3 to 6 month time frame is a reasonable expectation.
Well, and I think too, Scott, to your point, it's not just about valuation, but it's also about buyers at the table and diligence. The realities are, if you know where all the bodies are buried and you've identified those clearly in your process before you go to market, then you're going to be in a better position to be able to answer the questions. I mean, the worst thing in a diligence is where somebody asks you a question and you don't know the answer, or you're kind of hiding the answer, so you're trying to delay it. And all that does is basically make that buyer less likely to close, or close at a lower rate, or take longer, because they're going to want to drill in deeper. If you can be crisp and clear when you're in the market about those issues, there's no question that that's going to increase both likelihood of that buyer staying in the process and value.
So let me give the back end of that, because you're 1,000% right. We've tracked every acquirer and what they've bought in the market for 9 years. We know how they pay. We know how they value. We know what state they bought in. We know what state they still have to acquire in. So not only do you have to be ready, Mike, to answer questions and have a very organized data room, have a model that could be explained and supported, you should only be going after those buy-side players, whether it's capital or M&A, that have a need for you, that don't have a position in that state or in that supply chain. That's what we bring to the table through the deal tracker. We've tracked every deal. We know what buyers buy. We know how equity investors invest, where and how, and we know how the lenders lend money. So the combination of what you're talking about, Mike, which is really readiness, and then having much more of a targeted sniper shot approach to which buy-side players need you, that increases the likelihood of getting a deal done in a reasonable period of time.
So Scott, is an audit required in order to, make sure that all these numbers that are being presented in the data room are accurate?
I'm preaching to the choir here, guys. Obviously, for the public companies, and I'm particularly on the acquisition side, you're going to need a PCAOB audit, a qualified audit firm to justify the historical numbers and the forecasts. At the very least, you need a Q of E. But the answer is yes, but specifically to the pubcos. That's where that requirement really exists.
And it depends on the materiality of the transaction as well. Like if it's a non-material amount, you might be able to get by with less of an audit, more of just an opinion,
All right, thank you.
You guys want to go to the next slide?
Next slide. So what are your options? Michael, why don't you take this one on?
Yeah, so I think, as a follow-on to our prior conversation, everybody has every option until they don't. And what we mean by that is part of this is it's about timeline. So to the, Scott's comment earlier about 4 to 6 months to go to market, the realities are that if you have a year a year is a wonderful amount of time to be able to consider all the different options and what you can do, particularly if you're looking at something like the go public option, which is going to be more complicated. But essentially, a lot of this decision point is going to come around how much time do you have? And we talked about it as a group earlier, and kind of came to the 6 months is optimal. As you get below 6 months, you start to have more and more challenges about which one of the options you have. But essentially, you're going to go out and you're going to have to figure out, do you want to raise capital or equity? And you have to ask yourself and the people that you already have involved in your company, either the investors or the debt holders or other people, what they're likely to be interested in participating in, or what outcomes they're looking for. And you have to weigh that, because you're not going to be able to satisfy everybody, but it's a consideration. And then you need to see whether maybe you need some more time. And so if you need more time, then you want to start thinking about maybe sale leaseback as a way of getting more money in to be able to fund yourself for a longer period of time. Looking at non-core assets is another area where we found that if a company basically, they've sometimes you've got to stop and look around. When I was young, somebody taught me, if you're playing pool, the first thing you do after every shot is you walk all the way around the table so you can see all the different angles and shots that there are. And one of those is on non-core assets. Sometimes you end up with things in your business that came early on that you inherited or that were important at one point in time, and you're still supporting them, but they're not as critical. And so being really thoughtful as you analyze your core business, what your real value is, and being able to look at, say, what are the non-core assets? And then obviously it's going and trying to do a transaction. If you can't, if you're not going to be able to operate within the existing structure, then you need to go and look at a transaction. And I think that's kind of where we've seen a lot from the Viridian folks about how that looks and where it goes. And then finally going public, that's an obvious one. I think there are a lot of challenges right now in the obviously in the overall market, and there's certain places to go. But I'm sure there's some more input on that. But I think those are kind of where you're looking at your options, but you have to start with that understanding what you've got, and then understanding sort of how much time do you have to pursue these options, and also understanding the constituencies that you have about what they'd be willing to support, because those are all going to play in.
Yeah, Mike, if I can add on to that, we don't take 4 to 6 months to get a company to market. If we did, I'd probably shut the door. We want to get out in 30 to 45 days and close a deal within 4 to 6 months. But we've been talking about valuation and modeling and getting ready. To us, refining a model for a client, so if it's of institutional quality, doing a valuation on what does an equity raise look like in terms of cost of capital and dilution, same thing on debt. And if you're going to sell your company, what's the likely enterprise value? And is it based on revenues or EBITDA? Another consideration is what you're talking about, Mike. So we can literally value your options and give you a number or range that is supportable because we've watched every deal. But we're also going to tell you what's likely to happen or not likely to happen, and how long it's going to take to close a deal, and how many equity investors are there truly that are going to be looking at your company. And the same thing for lenders and same thing for buyers. So it's not only a quantitative analysis, what is a valuation of equity, debt, or selling your company? There's a qualitative analysis, because in this market, there are fewer buy-side players. So you're going to have to know a probability of getting a deal closed, and what you're talking about, Mike, the timing of getting a deal closed. So it's really a qualitative and quantitative approach to helping our clients figure out the right strategic step to move forward with.
Yeah, I would add in there that some of that 6-month timeline that you're talking about is stuff these companies can do before they even retain a banker. And that is trying to clean up their accounting. We see a lot of financial statements that are just not usable. And we end up doing a lot of, basic forensic accounting, trying to put together a set of statements that are explainable and logical and don't have a lot of unreconciled differences and things like that. So in order to really get yourself set up to pursue any of these options, the first step is to go back to your accounting system. And, I think from my point of view, a good first step is to say, can I produce monthly income statement, balance sheets, and cash flows? Can I do that? Have I ever seen those? And I'll tell you, that cash flow statement is something that is the big missing gap. I would say that maybe 40% of the companies that we talk to have never produced a cash flow statement.
And
so,
Frank, you're
yeah.
absolutely right, because we, that's what we do a lot with our clients, because what we also realize is sometimes as part of this whole process, there's managing expectations too, about getting people to understand what is within the realm of real. And if you don't have a good baseline to start with, even internally, it becomes problematic because people have expectations about, oh, this is what we think there is, but the reality is they're basing it off often limited information and incorrect information. So we completely agree with you.
And I would add that, from a tax perspective, you really got to do some due diligence to see what sort of positions they've taken on 280E, how aggressive have they been. Many companies are not even paying their taxes. They're filing returns, but they're not making the payments that need to go with those returns. And so, there's a lot of contingent liabilities that are hanging out there that need to be, reviewed before you pull the trigger and do a deal.
That's a good point.
So let me ask you this, Scott. Safe banking plus didn't pass, and obviously if it did pass, it would have been a major benefit to this industry, and it went through the House several different times and never makes it through the Senate. What are your thoughts about it passing here in the next year or two before the next presidential election?
Mike, we're all old enough, I think, to remember the magic 8-ball where you shook it up and it came out with an answer. Well, I can give a better answer than the magic 8-ball at this point in time, because who the F knows? Because not only did it not pass the House 6 times in a row, it never got to a vote in the Senate. It's not like it got to a vote. So I don't know. At this point in time, we've taken the SAFE Act out of our minds. There's a lot of bipartisan support for it, including leadership of both sides of the aisle. This does not lack support from both parties. It has support. It's just never been of interest, of intrigue. And I think ultimately in the eyes of the politician, it's not moving the needle on who votes for them.
Yeah, that's a key point, Scott.
That's the bottom line in all of this. So even though 70+% of the country, in terms of the populace, lives in a cannabis legal state, Gallup polling continues to be near 70% for federal legalization. So we don't know. What we're hoping happens at this point, from a regulatory process perspective, there's been, Biden, I guess about 5 months ago, came out and said, we're expunging the records of federal indictments on people that were, busted for possession. And that was like a couple of thousand people. That's great. And I think he came out today or yesterday in a statement to support Black History Month that he's pushing that forward to the state level, looking for more expungements. And he validated or confirmed what he said 5 months ago. He's asked the DEA, which controls the Controlled Substance Act, to take a look at whether cannabis should be rescheduled down to either 2 or 3. Because the fact that it sits next to LSD as having no medical benefits and highly addictive is, you put in the adjective. The key in this, and I'll finish up, if it gets rescheduled, forget about descheduling. I think that's a ways off. If it gets rescheduled, continues on the Controlled Substance Act, but it gets rescheduled to number 3, that eliminates 280E. Getting down to a Schedule 3 eliminates 280E, which is the most draconian, harmful, IRS-enforced rule that the government said, this is still illegal, but I'm sticking my hands in your pockets, Mr. State License Companies, and you're going to effectively pay a 70% tax rate. So the amount of cash flow, free cash flow, that will be unlocked if we get down to Schedule 3, and the impact on the valuations of these companies because of the visibility of cash flow is exciting. And I think there's probably a better likelihood of that happening this year than safe banking.
Yeah. Thank you, Scott. You know, Michael, I know we've been talking about timing and hey, more time the better. But what if you don't have a lot of time? You know, what if your cash flow and your circumstances are such that you don't have a year, you don't have 6 months, you're really just trying to make it to the next quarter. What are some things that they should consider doing?
Well, I think, one of the questions is, can you make more time? And that's where we go back to extending runway. Extending runway, you can either do that operationally, or you can do that by either selling off assets or, divesting various parts. So trying to create some runway to see if you can do that. And then I think the reality, Mike, is that it's likely going to impact your valuation, but essentially you go through the same steps, but you just have to do them more quickly. So as Scott pointed out, you basically, maybe you don't spend as much time on the book or in the go-to-market piece. You go more quickly. You also you may go broader, but you're likely to more likely to go to, say, strategics or people that could move more quickly, as opposed to parties that would take longer to do it. And then I think it's really about driving the process. The biggest challenge in anything is that if you have more time, everybody wants to take more time. And when you have less time, you have to just make sure that you've got a partner that's with you to make sure that they're driving those timelines to be aligned with what you can do.
Thank you, Michael. Chad, I'm getting, some questions from our audience about, what are the common roadblocks that occur during financial due diligence?
Well, from my end, a big part of it is just messy financials and the lack of support for a lot of the numbers on the financials. So a lot of deals fall apart at the end of the day, or in some cases can't go to market because of lack of support for the numbers. And so I think this is not just like an accounting exercise to have something to hand over as well. Think of it as a really must-have to have good diagnostics on your business. So along with, just your historical accrual-based financial statements that are valuable, it's valuable to also employ like a 13-week daily cash flow projection so that you know what your runway is really at any given point in time, regardless of what option you're pursuing. So I think one of the biggest roadblocks we encounter, though, is lack of like the visibility to actual cash flow supporting the numbers on the financials that were presented to us. And so oftentimes there is fairly significant cleanup, which really elongates the entire process. It throws that 6 months could become 9 months if you have to do 3 months of cleanup to assess where you're at. So I think that's kind of the good housekeeping, if you will, is and the ability to easily for investors to easily digest and see that the numbers are supported.
Thank you, Chad. Frank, you're in these numbers day in and day out, and it looks like overall the cannabis industry is undervalued. What do you think it's going to take to turn this around so that their valuations improve?
Sure. Well, it's an interesting question. I think the knee-jerk reaction is legislation, but I think that there's some things that could happen before that. One of the things I think is key is, all the managements we talked to have all been saying the same thing from the beginning of the year, which is we're tightening our belts, we're cutting OpEx. We've seen that. They've done headcount reductions, so we've seen some of that. They've all been talking about improving their working capital management, tightening down their receivables collections, things like that, cutting back on capital spending, and in general, becoming cash flow positive. I think that's what the market is looking for is, can these companies actually be internally supportable? Can they exist without just a wide open capital market spigot giving them cash? So I think, proving that you can achieve cash flow positive is a key towards valuation. And we've seen a couple of companies that have achieved that. So it is possible. It's challenging given 280E and the commodity price pressures, but it can be done. So that's one thing. I think it's also interesting to think about, and maybe somebody else on the panel can speak to this, but Canopy has this interesting experiment going with their US operations that potentially might give a roadmap towards, uplisting to the TSX. And, that's one of the things that holds back valuations in this sector is there's just no trading volume. Trading on the CSE, you have a fraction of the volumes, and institutional investors are kept away because they just don't have liquidity in these shares. So more liquidity could help volumes, and maybe uplisting to the TSX is at least a kind of a partial step. It's not NASDAQ, but it might be a help. So achieve positive cash flow, get more, do what you can to get more liquidity in your stocks. Those are my two best answers. I'll pass it on to somebody else.
Thank you, Frank. We've got a couple of questions involving SPACs, and they were very popular, a few years ago, and they've kind of fallen out of favor, not only in the cannabis industry, but the overall, capital markets themselves.
Sure.
Scott, do you want to discuss, what's happened to SPACs and why we don't see them as much as we used to?
Well, like you say, Mike, it's not just endemic to the cannabis industry. The SPAC world melted down globally. Guys, are we still on?
Yep.
Yes.
Sorry, I got to notice that something expired. The issue with the cannabis SPACs from our perspective is, and we did this analysis, I don't know, 6 months ago. I think there were 24 cannabis SPACs, about half listed in Canada, NEO, CSE, half listed here in the US. They raised on average $200 million on average, which at the time we thought, holy shit, that's got to be institutional capital coming in. It's not retail. You don't do a $200 million SPAC IPO on the back of retail. So we thought that was a sign maybe the institutions were playing the SPAC game because they could go out and acquire good assets. The problem is, as you guys know, the SPAC typically has an enterprise value rule that the target acquisition has to represent 80% in enterprise value of the money you've raised. So if you've raised 200 million, you got to go and acquire a company that has $160 million enterprise value. And typically you're buying private because you're playing the public-private arbitrage, right? There's not that many private companies that have $160 million enterprise value. You'd have to be buying the smaller MSOs or the mid-size MSOs. And for the SPACs that listed on NASDAQ here, they can't buy plant touching. So they were forced to look at CBD. They were forced to look at software. They were forced to look at lighting companies. None of those companies had the size. It's why so many of the SPACs either returned the money because they couldn't meet that 80% enterprise value rule, or frankly, they just overpaid. We saw the announcement of Ruth Epstein's SPAC, BGP, I think it is, that bought Craft Cannabis. Ruth's a very smart lady. Looks like she paid a very rich enterprise value for the company. We haven't looked at the deal very specifically, but that's the answers to why so many of these cannabis SPACs failed. They raised too much money and couldn't find the target.
And just real quickly, SPACs for us on the distress side, we see, it's kind of like the IPOs back in the dot-coms. There was a lot of money raised. And so when you have that money going, it's going to go to companies that aren't quite ready earlier, things like that. And then they're, even the ones that did go public, Now you've got 2 years and they need to raise more money, and they're probably going to have problems because they weren't ready for it then and they're not ready for it now. So we actually see that we think a lot of distress will be happening there.
Yeah,
That's-
thank you, Michael and Scott. And unfortunately, folks, we're about out of time here. Thank you again for attending. As you can see there on the slide, there's our contact information. If you have some follow-up questions you'd like to address to one or more of us on this panel. Thanks again for attending today.
Thank you, everybody.
Thanks.